Most founders think getting a license is the hard part. They think once the paperwork is signed, the real challenges are over. But here's the truth. Getting licensed is just the beginning. It's staying licensed, staying audit ready that separates the startups that scale from the ones that stall. Because the first audit isn't just a formality. It's the real test of whether your leadership, your systems, and your culture are strong enough to survive in a regulated market. If you can't pass the next audit, you can't scale. You can't close the next funding round. You can't survive expansion into bigger markets. You might not even realize you're failing until it's too late to fix. Today, I'll show you exactly what it takes to be audit ready from day one, especially if you're building your first fintech or crypto or digital asset company. Because getting licensed is step one. Leading under scrutiny, that's where real companies are made. But before we dive into today's roadmap, let's quickly set the stage. If you've been following this series, you already know where we've come from. In the first video, we broke down the leadership mindset you need to even qualify for a license in markets like Singapore, Hong Kong, and Dubai. We've talked about why leadership isn't just about speed. It's about resilience, regulatory trust, and building systems that last. Then in the second video, we pulled back the curtain on why so many fintech startups stumble during licensing. Wrong regulatory paths, wrong assumptions about timelines and costs, and wrong understanding of what getting licensed really means. We saw how founders burn precious runway chasing the wrong license, misclassifying products, and underestimating internal readiness. And today, we're connecting all these dots. Because mindset and strategy are just the beginning. Execution is what matters now. And execution in regulated markets means audit ready long before the auditors actually show up. That's what today's session is all about. Building not just a licensed company, but a trusted audit-proof one. Audit readiness is about proving at any moment that your company deserves the trust of regulators, investors, and customers are placing in you. It's about operational discipline, leadership visibility, embedding credibility into your culture, long before anyone ever asks you to. Because here's the secret. Auditors don't just check if you have the right documents. They check if you have built the right company. They check if your people understand the risks, if your processes hold up under pressure, if your leadership actually walks the talk. That's what we're here to build today. A company that's not just technically licensed, but a strategically trusted one. Let's dive into exactly how you get there. The first pillar, leadership accountability. Regulators don't just audit your operations. They audit your leadership. They want to see that people in charge aren't just figureheads. They're actively managing compliance, risk, and governance. Think about what happened with FTX, a $32 billion company wiped out because there was no real board, no oversight, and no internal accountability. It wasn't just a financial failure, it was a leadership failure. Regulators today remember that lesson very well. In Singapore, Dubai, and Hong Kong, they are increasingly asking not just where are your policies, but who's responsible and how do they react under pressure. If you can't show clear governance, you're red flagged. Not because of what you say, but because of how you operate when nobody's watching. Here's how you get ahead of that. Number one, document every major compliance decision. Meeting notes, approval flows, escalation protocols. Number two, ensure your leadership team reviews and signs off on key risk reports quarterly. And number three, appoint visible named individuals responsible for compliance, risk, and governance in your org chart. This isn't just about satisfying an auditor. It's about embedding leadership into the DNA of your company. The companies that survive audits and attract serious investment are the ones where leadership doesn't hide compliance in the back office. They lead it from the front. So let's go to the second pillar, real compliance fluency. Let's talk about your team. Because audit readiness isn't just about your compliance officer ticking boxes. It's about your entire team speaking compliance fluently, just like your engineers speaking code. But here's the reality. 93% of fintech report struggling with compliance requirements. Over 60% paid at least $250,000 in fines last year for issues like KYC failures, AML breaches, or missing transaction records. It's not enough to just have a policy anymore. Your engineers need to understand why KYC matters. Your product managers need to understand what OFAC sanctions mean for your user flows. Your operations teams need to understand how to spot a suspicious activity alert before regulators do. So here's how you build real fluency. Number one, host quarterly compliance town halls where you break down real-world cases, what went wrong and how it could have been caught. And two, Run regulatory drills where your team simulate mock audits, customer data reviews, and suspicious transaction escalations. Number 3, use practical playbooks, not 50-page policy documents no one reads. Startups that invest early in team-wide compliance training consistently shave off months of their audit preparation time. It's not magic, it's culture. Teams that practice explaining compliance in plain language are always better prepared when auditors actually show up. Bottom line, if your team can't explain your compliance framework in simple terms, you're not ready for an auditor. And now pillar number 3, risk-first product development. Now let's shift to something that derails more startups than almost anything else, risk management. If you build your product first and think about risk later, you're setting yourself up for failure. Here's a tough truth. 75% of FinTech startups fail, and poor risk planning is one of the biggest reasons why. Risk management can't be bolted on after your MVP is built. It has to be embedded in your product from day one. Think of it like architecture. You don't add a foundation after you've built the house. So here's how you embed risk-first thinking. Number 1, maintain a living risk register from the earliest stages. Document every potential regulatory and operational risk. Number 2, conduct risk mapping sessions with your product, engineering, and compliance teams before major releases. And number 3, evaluate each feature. Does it trigger a new compliance obligation? Does it increase exposure to AML risks? Does it touch user data subject to privacy laws? Fintechs that integrate compliance design reviews early consistently report faster regulatory approvals and fewer product recalls. Remember, regulators are not just looking at your final product. They're looking at whether you had the foresight to design with risk in mind. Pillar number 4, internal audit pathways. Now, even with leadership, fluency, and risk-first design, there's one more piece you can't miss: self-assessment. Smart companies don't wait for auditors to catch mistakes. They run internal audits first, proactively. Internal audits aren't about punishing mistakes. They're about finding cracks before they become chasms. But here's something most founders don't realize. Internal audits can easily turn into political theater, especially if the compliance teams audit itself. Nobody wants to show imperfections to leadership. Nobody wants to flag a gap that might seem like their own fault. That's why internal audits should not be led by the compliance team. The people or function coordinating with the internal auditor, whether the audit is internal or outsourced, should come from operations, risk, or another independent team. The goal isn't to present perfect scores. The goal is to catch real weaknesses early and fix them before they ever show up in a regulator's report. Here's how to start. Number 1, conduct quarterly mock audits. Pick a session, like AML reviews, KYC onboarding, or data protection, and pressure test it. Number 2, document everything: policies, workflows, transaction logs, suspicious activity reports. And number 3, practice audit readiness. Simulate surprise audits so your team gets comfortable responding under pressure. Companies that build internal audit pathways often shave months off their licensing timelines because they spot gaps early before regulators do. Think of your internal audits like fire drills. If you wait until the real fire happens, it's already too late. And the last pillar, pillar number 5, financial planning for compliance resilience. So what does that mean? Let's talk about the backbone of audit readiness: money. Most founders plan for legal fees. They plan for incorporation costs, maybe even a few months of compliance consulting. But very few founders plan for what happens after that. Here's the reality. Getting audit ready and staying audit ready costs real money. It's not a one-time cost. It's an ongoing operational commitment. If you don't budget for it, audits can quietly bleed your runway dry. Here's what real financial planning for audit readiness looks like. Number 1, you may have a budget of 5 to 10% of your operational expenses for compliance upkeep, training, audits, reportings, security, and so on. Number 2, plan for external audits every 12 to 18 months, even if you're not legally required to. It builds discipline. Number 3, hire a fractional CFO or compliance finance specialist early, not just for bookkeeping, but for true financial governance. Number 4, build a compliance reserve into every fundraising round, just like you plan for engineering or marketing. Because here's the thing, regulators don't just audit your policies, they audit your financial discipline too. If you're scrambling to fund audits after you're already under review, you're signaling weakness. Startups that treat compliance costs as technical debt, something they have to pay off later, usually find themselves crushed by it as the worst possible moment. Those that plan for it survive. Compliance isn't an expense, it's infrastructure. And smart founders know you don't scale fragile infrastructure, you fix it early. So, just to recap, the 5 pillars are leadership accountability, team wide compliance fluency, risk first product development, real internal audit pathways, and a strong financial planning for compliance. If you start building these foundations now, you won't just survive your first audit. You build the kind of company that investors trust, regulators respect, and customers stick with. If you found this helpful, I invite you to dive deeper. Check out the first 2 videos in this series. The links are below in the description. You get a full blueprint on how to approach licensing and regulatory leadership. If you're serious about scaling in regulated markets, subscribe to this channel. Every week, I break down frameworks just like this. No hype, no jargon, just what actually works. If you want personal feedback on your audit readiness or licensing strategy, the link for a strategic review call is also in the description below. Audit readiness isn't just about passing a test. It's about proving you're the kind of founder who builds to last. Thanks for watching. Let's build smart. See you next time.